Have you ever asked yourself this question? Why did you do everything right and still end up losing? You researched Bitcoin, you waited for institutions to show up. You watched BlackRock launch its ETF, MicroStrategy drop billions to StackSats, institutional money flooding in like a tidal wave. You bought in November 2024 at $104,000. Your logic was airtight. Then, it dropped to $85,000. You started second-guessing yourself. Did I read this wrong? Am I missing something? No, you didn't read it wrong, you just didn't know what kind of game you'd walked into. My name's Toomey, and I've spent way too much time trying to figure out why assets never perform the way they're supposed to. I've spent way too much time trying to figure out why assets never perform the way they're supposed to. If you bought Bitcoin somewhere between $18,000 and $95,000, you believe in the tech, you understand the scarcity argument, but you can't wrap your head around why institutions are piling in while the price just sits there. Then, what comes next was written for you. Because the answer isn't in the charts, it is inside a financial structure that has been around for over 100 years. Let us start with a story from 1982. In 1982, Mexico made a decision that seemed completely reasonable at the time. They borrowed hundreds of billions of dollars from international banks to fund infrastructure and economic development. The problem, that debt was denominated in US dollars, not pesos dollars. Mexico couldn't control the dollar, they could only earn it through exports or keep borrowing. Then the Fed jacked up interest rates to fight inflation, the dollar surged, the peso collapsed, and Mexico's debt payments exploded overnight. $80 billion in debt, and no way to pay it back. The IMF showed up with what they called a rescue plan, but what did that rescue actually cost? State-owned companies privatized, social spending gutted, markets thrown open to foreign investors. Mexico traded away its sovereignty, piece by piece, just to keep breathing. The same script played out in Argentina, Brazil, Indonesia, over and over again. That is a debt spiral. You owe a debt in a currency you can't control. When outside conditions shift, your options disappear. You're forced to sell your most valuable assets at the worst possible terms. Now, apply that same logic to MicroStrategy. Imagine you own a house worth $500,000. You take out a $100,000 home equity loan at a variable rate. $400 a month, no big deal. Then, the Fed raises rates, your payment jumps to $900, then $1,000, then $1,200. Your income hasn't moved. Now you've got three options: sell the house, refinance, take on more debt, or default. Every option is a trap. The harder you fight, the deeper you sink. The bank didn't break any laws, it just engineered a structure where, the moment conditions change, you're cornered. Now swap the house for $60 billion worth of Bitcoin. Swap the home equity loan for $16 billion in convertible bonds and preferred stock. And swap you for a publicly traded company whose stock price directly determines whether it can keep holding Bitcoin or gets forced to sell. That company is MicroStrategy. MicroStrategy currently holds around 450,000 Bitcoin, roughly $45 billion at current prices, bought at a cost basis of about $27 billion. That is around $18 billion in unrealized gains on paper. Sounds beautiful. How does it actually work? But they're also carrying roughly $16 billion in debt obligations. Convertible bonds have interest payments, preferred shares have dividends. And preferred dividends aren't optional, they're mandatory. Miss one, and you're in default. So, MicroStrategy needs roughly $700 million a year just to service debt and pay dividends. That is close to $2 million every single day. Their software business generates about $100 million in free cash flow, nowhere near enough. So they've built up roughly $1.2 billion in cash reserves, specifically to cover that gap. At the current burn rate, that cash lasts about 20 months, under 2 years. That is the countdown clock. MicroStrategy's whole business model is essentially a flywheel. Stock trades at a premium. Issue shares to raise cash. Buy more Bitcoin. Bitcoin goes up. Stock premium holds a issue more shares. When it is running, it is elegant. But the flywheel has one critical requirement. The stock price has to stay above net asset value. The moment the stock drops below NAV, issuing new shares is the same as selling Bitcoin at a discount. That door slams shut. The moment the stock drops below NAV, issuing new shares is the same as selling Bitcoin at a discount. Now, the $1. Scene transition, end of segment. 2 billion cash reserve becomes the only firewall and the countdown begins. If they're forced to sell Bitcoin to service the debt, Bitcoin's price falls. Bitcoin falls, the stock follows. The stock falls further, more pressure builds, and they're forced to sell even more Bitcoin. They're forced to sell even more Bitcoin. That is the death spiral. Who would actually want this to happen? You're a major investment bank. Your institutional clients, pension funds, sovereign wealth funds want Bitcoin exposure, but due to regulatory constraints, they can't just go buy it on an exchange. But what if MicroStrategy gets forced into a distressed block sale? They won't sell on the open market. They pick up the phone and call a handful of big banks. We need to move $5 billion in Bitcoin. Anyone want it? The banks say sure, but we want a discount. We're absorbing the risk. And just like that, those institutions walk away with billions of dollars in Bitcoin at 70-80 cents on the dollar. But for that to happen, MicroStrategy has to actually be in trouble. The stock needs to fall below NAV. The cash reserves need to drain. The pressure needs to keep building. How do you manufacture that pressure? You short the stock. This isn't theory, this is history. I have the historical record. In the early 2000s, there was a financing structure called a death spiral convertible. A cash-strapped company goes to a hedge fund for a loan. The fund says, the lower your stock price goes, the more shares I get. That structure directly incentivizes the lender to drive the stock price down. How short it, leak negative news, manufacture fear. The SEC investigated hundreds of these deals in the early 2000s. The findings were brutal. Companies that entered these agreements saw their stock drop an average of 34% within a year. 85% had negative returns. 48% were fully delisted, bankrupt, gone. This wasn't hypothetical. It happened to real companies, real investors, real people who lost everything. And it was all completely legal. MicroStrategy's debt structure isn't identical to a death spiral convertible, but the psychological mechanics are the same. In February 2025, MicroStrategy's market cap dropped $10 billion below the value of the Bitcoin they held. Think about what that means. You could get Bitcoin exposure at an 18% discount just by buying the stock. The market was pricing in the death spiral risk in real time. At the same time, short interest in MicroStrategy surged into the billions. Famed short seller Jim Chanos publicly announced he was shorting the company. JP Morgan published multiple research reports calling it overvalued and structurally dangerous, and noted that if the stock kept falling, MicroStrategy could get kicked out of major indexes, forcing index funds to dump their shares and accelerating the decline. Is that manipulation? No. It is using the rules to compress the space, completely legal. Just as effective. There is a comment I've seen floating around that nails it. I have complete control over Bitcoin's price. If I want it to drop, I just buy some. It is a joke, but it is not entirely a joke. When retail sees Bitcoin drop from $105,000 to $85,000, the first instinct is, did I get this wrong? Should I cut my losses? When institutions see the same drop, they're asking a completely different question. Why is it falling? Did the fundamentals change, or is someone manufacturing sell pressure? Different question, completely different action. Retail stops out at $88,000. Institutions added $85,000. A few years later, Bitcoin is at $150,000. Institutions take profits. Retail stares at the chart, wondering why they didn't hold. That is how wealth transfers, not fraud, not crime, just information asymmetry. Combined with psychological pressure applied at exactly the right moment. So what do you actually do? 1. Separate Bitcoin from MicroStrategy. Bitcoin is a decentralized asset. MicroStrategy is a publicly traded company with a complex capital structure. If MicroStrategy hits trouble, that is a story about one company's financial decisions, not a verdict on Bitcoin's underlying thesis. 2. Pressure creates opportunity. If institutions are manufacturing sell pressure to accumulate Bitcoin at a discount, that is itself a signal. It means they believe in the long-term value. They just don't want to pay full price. Panic selling at $85,000 is handing your position to the people waiting to buy it cheap. 3. Set a real tripwire, not price, fundamentals. MicroStrategy publishes quarterly earnings with detailed info on cash reserves, debt status, and Bitcoin holdings. If those cash reserves start draining fast, if they're actually being forced to sell Bitcoin, that is the real signal. Until then, price swings are noise, not signal. 4. Know what you're actually holding. The people who understand debt spirals, convertible bonds, and short mechanics see something completely different when prices fall. Knowledge doesn't make you a prophet, but it keeps you clear-headed when everyone else is panicking. Back to the question we started with. Why did you do everything right and still end up losing? Because doing the right things isn't enough. You also need to see whether someone is using leverage you can't see to move the ground beneath your feet. In 1982, Mexico, as economists, didn't get it wrong. They just didn't know that the Fed's interest rate decision would turn their debt into a noose. In the 1990s, people watched the Bank of England sell off half of Britain's gold reserves at $275 an ounce and thought it was sound policy. 20 years later, gold was at $1,900. Who bought that gold? You don't need to believe in any conspiracy to understand the logic. You just need to understand one thing. Smart money always quietly takes what it wants while everyone else is afraid. They don't bother engineering a complex takedown of an asset they think is worthless. What they carefully hunt is what they want, but don't want to pay full price for. So, if you are looking at Bitcoin at $85,000 right now and you are scared, ask yourself one question. Do you believe in this asset's long-term thesis? Smart money ignores what it doesn't want and hunts what it does. If you do, then the fear you're feeling right now isn't a threat. It is a test. If you don't, then you were never supposed to be in this game to begin with. Because the rules of this game have never changed. Keep your position, survive the deepest fear, and watch the people who manufactured that fear push the price exactly where they always needed it to go. See you in the next one.